Hi, and welcome to this Investing Insight. My name is Jason Gunkel, and I lead our investment team at Severson Strege. If you own an S&P 500 index fund, you might think you are more diversified than you actually are. Yes, you do own 500 different companies, but a big percentage of your returns are really riding on just a few. The S&P 500 is what's called a market cap weighted index. That means the bigger a company gets, the bigger its slice of the index it becomes. Right now, the Magnificent Seven stocks, as they are called, Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla, make up about 34% of the entire S&P 500. Widen that to the top 10 largest companies, and you're over 40% concentrated. That leaves the other 490 plus companies in the index, splitting the remaining 60%. That hasn't been such a bad thing in recent times. These companies have driven a huge share of the index's return the last few years. But concentration cuts both ways. When a handful of mega cap tech stocks account for that much of the index, your so-called diversified fund is really a concentrated bet on the technology sector doing well. If sentiment shifts, or if one of these companies stumbles, or AI spending doesn't pay off the way the market currently expects, that risk doesn't stay isolated to just a few stocks. It drags the whole index down with it because those 7 names carry so much weight. That has been more of the case this year, where the performance of those 7 companies has been much more mixed. So what's the better alternative? We believe that a traditional index can be improved with less concentration risk while still keeping expenses very low. I'll walk through exactly how that works in some future videos, but for today, the takeaway is simple. Know what's actually inside your index fund before you assume it's diversified. Thanks for watching today's Investing Insight. For more information, you can visit our website at seversonstrege.com.